although you don't have a Google or a Zoom or any success anywhere similar to those, but around 9 out of 10 would actually make money. So the overall portfolio returns more than an average VC portfolio would return.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Ibrahim Abdel with us. Ibrahim is a founder and managing partner at Moonbase Capital, where they are investing in search funds. In this episode, we'll talk about what are search funds, how they're different from startups, what's the return profile investing in search funds versus investing in startups, that is venture capital, who are the people who are starting these search funds, investing in stages to de-risk the investment, examples of search funds, and lots more. So without wasting any time, let's dive straight in. Hey Ibrahim, so good to have you on the VC 10X podcast. How are you doing?
Hi, Prashant. Thank you for having me. I'm doing great.
Yeah, it's a pleasure having you on. And to start things off, can we first have your story and why you started Moonbase Capital?
So basically, I come from a family where my father founded an SME in the 80s. So growing up, he was always pushing me to come join the SME and grow it, etc. So I did. And early on, I noticed after 4 years that to actually grow it, you need to go and learn. So I started, I did my MBA at INSEAD 2003. And then to learn more, I joined McKinsey, the business consultants, for 4 years. Again, learning. And then I went back to the family business. For the first 4 years, we were fixing it, changing it. I thought it's going to be very easy, but no, there was a good learning curve. We did well. And then we sold a very big part of the business to a German multinational, and we stayed on. I say we because my brother, who's 10 years younger, had joined at this point, and we stayed on as running the business for the Germans for 6 years. So all over this 10 year of running SMEs, we did really well. The company grew a lot, but it was not an SME anymore. And at this point, I decided to go into tech. And Silicon Valley had this allure of Silicon Valley, and people gave me the advice: the best way to enter Silicon Valley is through Stanford, because Stanford is the heart of Silicon Valley, they say. And so I did another master's at the GSP at Stanford. However, I took at Stanford a course about search funds, and I was totally hooked because search funds, we're going to go into detail, but it's basically a way of investing in SMEs. And I know SMEs, I love SMEs, so for me it was very natural. And so then I left tech and focused on search funds, and that's what I do now.
Yeah, that's a very interesting story. And can you tell us more about? We're going to go deeper in the concept of search funds later in the conversation. But first, can you tell us what you're doing at Moonbase Capital? What's the investment thesis here?
So we at Moonbase invest in search funds, which is a way to invest in SMEs, basically. We do it. So after I started investing in Europe, I figured out that there is not so many investors in search funds that are as operational with a consulting and CEO background the way I do. So I found that my support was very useful for the searchers, for the entrepreneurs, because they want help. In search funds, they start first by looking for a company to buy, and then eventually, when they find the company to buy, the entrepreneurs, they become the CEO of this company, and they run it. So it's full of need for different support. So they get a lot of support from private equity people, because there's a private equity angle, for people who know M&A, and naturally business and strategy and culture, etc. So we always, from day one, we're all about helping entrepreneurs, working with entrepreneurs very closely, and this served us well. So Moonbase, the thesis is we want to be the ones that help the entrepreneur the most. And to do so, we depend not only on us, but also on the partners, but also we have an advisory board of 50 people who come in certain areas of support, and they support our entrepreneurs. So yeah, we invest in SMEs, and we support as much as we can.
Yeah, that's very interesting. And now let's talk about search funds. What are search funds, and how are they different from typical startups?
So search funds is a way to support an entrepreneur, but our entrepreneur does not have an idea the same way it happens in startups. Our entrepreneur wishes to become a CEO of a small company and grow this company. So they first they talk to investors like us to support them in the first phase, which is the phase of finding a company. And then after that, once they find the company, we invest with them in this company. It's very similar to VCs because it's again a number of different entrepreneur investors who invest in each entrepreneur. So you have a group of investors, each having a minority stake, and this entrepreneur then becomes the CEO. We go on the board, or maybe not. Some of us go on the boards, and then eventually we continue supporting this new CEO, who's the entrepreneur, to grow this business over 5-7 years, eventually selling it into either private equity like to buy it because the size is usually we take it up to the private equity size or regular M&A in the sector. So yeah, that's what search funds are.
Yeah, that's very interesting. So basically, how it's different from a startup is basically that the entrepreneur is not starting with an idea this time around. They are starting with the desire to become a CEO and run a business and grow the business, right? And
Exactly.
you're investing in them to help them find the startup that they will run and grow that further by investing in them, right?
Exactly. The only thing is they don't buy startups. They buy, I don't like to use the word boring companies, but they buy old school SMEs,
Okay,
which are very similar to my father's SME, which was B2B with 50,
right.
60 employees.
Yeah,
So you have a size of a company that's already been in the market for 30 years, usually a generation that does not have someone to succeed. So they say, you know what, let's sell the business. And usually, and always the business is successful and it's growing, but it's somewhat growing slowly with this generation. So it's yeah. So everything you said is 100% true. The only thing, we don't buy startups, we buy SMEs, old school SMEs.
yeah, that's very interesting. So these startups are not the typical VC backable kind because they are hyper scalable, high growth startups. So this is somewhat different than that, right? Uh,
Exactly,
uh,
exactly. So we
yeah,
don't look at startups that can become, or companies. We don't call them startups. We don't look at SMEs or companies
yeah,
that have the potential to be unicorns. So we're not going for the unicorn.
yeah,
So your question is very interesting because we are very similar to VCs in two aspects. One is that there is an entrepreneur who does the job and we support the entrepreneur. The other thing is that we put small tickets into a large number of SMEs, the same way a VC would put that diversify the investment over a lot of companies, not only one. And however, we also get from private equity two very good things. One is the fact that the company exists and you can go visit the company, look at the financials for the past years. So you have the risk is much less because you can see it, you can visit it. It's been successful for the past years. And the other thing which we take from PE, which is very useful, is the leverage. Because in the startup world and VCs, you don't take leverage to invest. Usually you invest through equity. In private equity, they leverage the company a lot when they go buy. For example, in our case, when the entrepreneur finds a company and goes to invest in it, the bank typically invests or helps by leveraging anywhere between 50 to 80% of the sale. So in a typical investment worth, let's say, 20 million euros, we would, all the investors together would put maybe 5 to 7 million, and the banks would put 10 to 12 to 13 million, which means that over the 5 years when the CEO is running this business, and because this business is one with positive cash flow and it's already making money, you pay off this debt over these years. So once you're exiting, if you already paid all of your debt, you only paid 5 to 7 million in equity, and now you're selling it. Let's say you grew it a bit and you're selling it for 30 million. So suddenly you make a very big return because of this leverage part, which is not something you find in regular startups.
yeah, that's actually very interesting. So you're investing in a combination of equity and debt. Is that correct?
So exactly, we as investors only put the equity part,
Okay,
but the deal itself has a
yeah,
big component of debt, and this
okay,
component is directly on the SME through yeah, um, basically the CEO or the founder, the
yeah,
CEO, which is our entrepreneur. When once
yeah.
they find the company and
Yeah.
they before becoming a CEO, when they're buying it, they go and talk to banks and they convince the bank basically to invest. So that's how it works. So part is the banks and part are us as investors.
Understood. Understood. That's great. And is there a possibility that these companies that you're backing in future go on to raise venture capital? Is that a possibility?
No, no, because venture capital is looking for a high growth,
Yeah.
R&D filled um, company, and in our case, m- we look for very specific criteria, and this criteria includes, for example, having one of the major things is we want things that you don't need to keep putting money to grow. So we don't like companies where you need capex to grow, and this is not the case with regular startups. Regular startups, you fuel it by putting money, so you can fuel marketing, fuel sales, and then you grow it. So it's a different twist. In our case, usually we sell to either private equity, because these guys are looking for a company that has stable cash flow, that is recurring revenue, and that is in a certain size. So usually you end up selling to private equity, not VCs at all.
Yeah, that's a very interesting model. So is there a specific name for this kind of asset class? Because it's definitely not venture capital. So what's this called?
Search funds. So basically, the name, although I mean I don't think the name is so catchy. So I think the name is,
Hmm.
but I mean there's two ways people talk about this. Either they say ETA, which is entrepreneurship through acquisition, or
Okay.
we say search funds. And search funds, the name
Okay.
comes because the first step when the entrepreneur decides that they want to take this route is they raise a small fund in order to search for a company. So they go to, the first step would be to go to investors like us, 20 of us maybe, and each one of us would give them anywhere between 15, 20,000 euros up to 40,000 euros for them to use this money in order to find the company. So they make this search fund, which is a 500,000 euro fund, and then they use this money for 2 years to build a website, look for companies, buy a database, and they actually go door to door database. They send emails. They really do it from the ground up in order to find this company. So it costs them money, and they need the salary themselves, and they have a team, and they have an office, they have lawyers, and then eventually they do due diligences. So they need the money for that. So the name search funds came from the fact that the entrepreneur starts with a small fund in order to search. Once they find the company, then you invest real money. So maybe if we put on average 30, 40,000 euros in the first stage, when they find the company, we put anywhere between 500 and 1 million euros, depending on the investor. But in our case, usually around 750,000 is the level where we invest. So it's two-step investment cycle, let's say.
Understood. Understood. So is Moonbase Capital a search fund, or are the people that you're investing in they running the search funds?
They are the search funds. So we invest in
Okay.
search funds.
You
So
invest in search
so
funds.
for
Okay.
example, now we are working with around 17 entrepreneurs, which also are, you can call them search funds. So we work with 17 search funds. Each of these search funds is looking for a company to buy. And the search funds is usually made up either of one or two entrepreneurs. So some cases it's a duo, in some cases it's just a solo entrepreneur. And yeah, we work with them over this period until they find it. Once they find the company, we are not obliged to invest in this company. So in some cases, you look at the company and you say, you know what, I don't like it. Or you work with the entrepreneur for 2 years, and when the entrepreneur find the company, you think, you know what, this entrepreneur might not be very successful, so I'm not going to invest. So you're not obliged. And if you decide not to invest, then the entrepreneur would return the money you paid in the beginning, the search capital, plus 50% markup also for your risk, for your time. So at the end of the day, um, you need to look at it as a two-step investment, and both steps are not linked to each other. So you can easily do the first one and then pull out if you want to.
That's very interesting. So there is also risk involved on the founder side, right? That if later on the investor is not convinced that you're going to be the right person to run this business, then they can just pull out, and then you will also need to pay a markup on that. That's a heavy markup, 50%, right? So there's a heavy risk involved on the founder side here, right?
100%. I mean, the searcher or the entrepreneur or the search funds would keep looking until at least 50 to 70% of the investors like it. And the investors are usually involved. So you know early on if they will like this company or not. And once you have 50 to 70% like your company, what you do then is you go out and look for additional investors that were not your original cap table. And these people would fill this equity gap, we call it. So, yeah, you always have people dropping out because that's the name of the game. Many of these investors are putting these chips on many entrepreneurs, and then they choose the best companies. And in many cases, they by the time this happens, maybe the fund is already invested, or maybe the investor doesn't want to continue. And in this case, they go out and find a new investor. However, if you only have 10 or 20% of your investors liking the company, then you keep searching. You ignore this company and you keep searching until your money runs out, basically. In some cases, and this happens around a third of the time, the searcher does not find a company. They keep searching for 2 years and they're unlucky and they cannot close a deal. And this happens actually in 30% of the cases. But then in the other two-thirds, when they find the company, they make up by giving you this markup. So at the end of the day, it makes up for losing some of the investments for people who don't find.
Right. And in case they don't find a company, what happens then? Are they going to return you the money?
You lose
Wha-
no, you lose the money. Now that's you lose the money because they already have spent it, and
Okay.
they just say sorry and they go to their own way.
Okay.
However, the two-thirds which find will give
Yeah.
you a 50%, which in the end pays for this third. You know what I mean? So at the end of the day, in
Mm.
Moonbase's case, in our case, we're lucky because so far all our searchers found companies. We didn't invest in all of them. So maybe we went into two-thirds of them, and one-third we didn't like it, so we went out. But so far all of our investors have been our entrepreneurs have been finding companies. However, if not, the 50% of the ones that find would pay for the third that you. And anyways, in the end of the day, this part of the investment is a very small part. So you pay
Yeah.
here 30,000 euros, and then
Yeah.
you pay 750 when you find the company. So this
Got
is
it. Yeah.
just a way to have a pipeline without
Hmm.
internally building the pipeline.
Absolutely. Yeah. I would like to understand the sourcing part. Like I know, like venture capital as an asset class is very popular. Founders know it, and there are a lot of founders automatically who want to start those kinds of companies. The allure of it, at the unicorn concept, all those things, right? Fancy stuff. But with this asset class, I know that there are a lot of good benefits with this asset class as well, wherein you can build a great company. You don't have the pressure of building a high growth company, have crazy growth, and because that's what VCs want. So building it in a sustainable way and having a good lifestyle as well at the same time, I think those are the some benefits that this asset class offers. But like, how does sourcing these people look like for you? Where do you find these people who want to go out on the search and find these companies? So this is one angle of the search that I would like you to tell me more about. And another angle is, once you find these people, then how are they going on the search for their companies that they want to acquire?
Very good question. So there is a community of search funds and search fund lovers that has been growing over the years. So search funds started in the 80s in a professor called Irv Grusbeck, who was a professor at Harvard, and then when he was at Stanford, he came up with a concept where he had a few students who wanted to search for a company rather than do a startup. So ever since the mid 80s until today, it's been growing slowly. So the concept has been proving itself. The IRR has been quite high. So people are slowly liking it. So now you have a good um, community, and there is some websites, like for example searchfunder.com is one website where the community usually gathers around. So what happens is, as a searcher, they start asking around who are the different investors, and they start looking and googling investors and search funds. And then what they do, interestingly, is they choose a cap table that fits their own needs. So for example, if you're a private equity individual and you know private equity really well as an entrepreneur, then you need more investors who know operations, who know strategy, etc., etc. So you choose your cap table based on the needs you want. So here is an interesting part when the entrepreneur starts talking to a large amount of investors and starts feeling which of those he would like to work with and have them invest in the fund. So you start off in a sort of both of us choosing each other a manner. So it's in many cases the investor likes an entrepreneur, but the entrepreneur doesn't like the investor anymore simply because they have this part or this experience covered in their cap table. So this is how it works. It's like a dance between the investor and the entrepreneur to see if there is a fit and if we will both work together well or not. And then so that's the way it usually works, by having these big discussions. This was your first question. Your other question was after, you said after that, I think. So after that, once they have the cap table,
Yeah.
they start working closely with these 15 entrepreneur investors. They start working closely with them in looking for this company, and depending on the investor, they work they choose how to work close or far. So, for example, we as Moonbase like to work closely with our people, and the way we do it is we insist on half an hour per month to have a catch up with each of our entrepreneurs. And during this half an hour, we just pinpoint where we could help them if there is a place and if there's a time to help them, and then we help them. There are other investors who talk to them every 3 months. There are other investors who say, no, you know what, if you need something, call me. So depending on that, they choose how to be close to others. But then the beauty is, you as an entrepreneur have a group of believers in you who are waiting for you to find the company. So once you find the company, they already know you well, they've seen it early on in the first stages, so they're ready to put the money. And we all agree, because the search fund world started in a university, and it's been well documented. So there are criteria that we as investors are all looking at. So, and this is the beauty of, we're all aligned. So you have a case where you have so many different players, but we're all aligned by the search fund model, basically.
Absolutely, that's great. Let's and what do these people who are like building their own search funds? What do they look like uh, in person? Like, are they past founders? Are they operators? Are they still holding their job while they're searching for this company that they want to acquire, or are they full time into searching? How does that work?
No, basically they're full time into searching. So once they decide they want to search, what they do is they start talking to investors. Before that, in many cases, they are ex MBAs. So in many cases, according to the statistics, most of them are MBAs, and most of them come from good MBAs, because historically search funds has been taught in specific MBAs, like many, but you have Stanford, Harvard, Chicago Booth, INSEAD. IESE has been very powerful in that, and IE as well in Spain. So you have these universities, and many of the MBA students choose it. And we have two types of MBA students, basically. You have ones that come from consulting and private equity. So you have someone who worked in consulting for a while, or is working private equity, and these are very sophisticated, but without a lot of leadership and operational experience. And then you have another bucket, another type of MBAs, who are people who are more operational managers in companies, who know how to lead people, etc. And these guys are usually not as sophisticated as the first group, but are good in leadership. And we work with both types. When they go out and find the company, we decide whether we want to invest or not, partly because of their backgrounds and their personality. Because by then, after 2 years of working with them, we know them quite well. And then you decide, you say, okay, this consultant is a brilliant person, but this company that he wants to acquire is very sophisticated from an operational standpoint. Maybe they will fail to do it. And in some cases, you refuse, even though the company is good, and even though even you like the consultant or the searcher, but there is no fit. And this is how we, yeah. So it's mostly MBAs, and you have different types. But young people, I mean, you have average age, and not very young as startups, actually. So average age is in the 30s, so 33, 35. Many of them had anywhere between 5 years to 10 years of previous experience, and honestly, it can be anyone. I mean, that's the beauty. You have such a diverse background of these people.
Yeah, that's certainly very interesting. And I would like to understand the return profile for this asset class, because for VCs, we know like they want really high return because that's what the asset class promises. What does that look like for search funds? Can they offer a similar return than VC scale startups, or if not, then what does it look like?
So, brilliant question. We don't aim for unicorns at all. So when we look at a company that we're acquiring, and we see an IRR of 30 to 50%, we're comfortable with that. So we don't necessarily want the huge returns. However, if you look at the portfolio, it's been noted by Stanford that the average IRR for the whole market, depending on the geography, but it's anywhere between 28% to 33% average for the whole market, which is very high. I mean, if you look at the average of startups, it's much lower than that. So although you don't have a Google or a Zoom or any success anywhere similar to those, but around 9 out of 10 would actually make money. So the overall portfolio returns more than an average VC portfolio would return.
Yeah, that's certainly a very interesting insight there. And talking from the LP perspective, because I believe you would have raised this fund from LPs. So how do they look at search funds? Do they have a similar share that they're allocating to VC, also going into search funds, or how does that look like?
So we are trying our best to work with LPs who like the search fund world and want to be more and more involved into it, but are either busy or don't know how to enter it, don't have a name yet there. So we work with people who like the model, who would like to invest and be somewhat active. So we took the same idea of a search fund, which is an entrepreneur that has investors that are helping. And then we did the same, just one step up. And we said, okay, we do an investment company where we have our LPs, our investors, are all people who are involved. So we have different ways to make them involved. They can be involved in interviews, they can be involved in mentoring, and so our LPs as Moonbase are usually people who are CEOs, young investors, people who like the asset class and want to be involved in it. However, that's not the case with all funds. So there are other funds who have strictly investor type LPs who don't want to be involved at all. But in our case, that's what we do.
Absolutely, that's very interesting. And would you like to share any examples of maybe the people that you've backed and the kind of companies they have started? Would love an insight into that as well.
Sure. So we've been backing up entrepreneurs for the past 2.5 years. From these entrepreneurs, around maybe 8 found companies so far. We invested in maybe 3 of them, and 3 of them we're investing now. So let me give you a few examples. So, for example, we have a company in northern Italy that is a waste management company. The beauty of waste management is that very stable industry, recurring revenue. It's usually you need license to operate, so it's not easy for anyone to compete with you. Margins are nice, and a lot of people want to buy it eventually. So, and these are entrepreneurs who want to go and do some M&A and grow it through M&A. So they do a roll up. We have another one in France, which is a producer of developer of websites and SEO for the French market. And the beauty is they target a small business mom and pop shops that need a website and are not digitized to do it on their own, and they give a lot of service. So again, it's recurring revenue. They have 4-year contracts, and it's a lovely business. I'm actually board member in this one. And then there is another one which is a it's in Germany, and it's a company that trades in photonics, which is basically pieces of. So let's say you have a company that does R&D for a product that requires lasers or any light ingredients, and so these guys help work on the R&D with them, and then eventually get them these pieces for your project. So again, it's very long-term projects, recurring revenue, good margins. So it's all within this type. So yeah, these are some examples of the companies we work with. But if you really see the pattern, you're talking about SMEs that are typical mom and dad shops that are nothing overly, based on R&D, or it's not a startup type at all. But you have certain criteria which make it so nice. For example, you always have them having good high margins, so you know for a fact that you'll be able to sustain even shocks. And then you have it with some growth potential. So all of these, either through M&A or through or regular growth, you can grow double, triple the business. You will not do it the revenue times 10 or times 20 the way you do in a startup, but you can easily double it or triple it. So you have this good growth, and you have fragmented industries always, which means that you don't have one player that can make your life harder, and you can, if you're good, you can buy a few others and you can grow within that, and then eventually consolidate and sell. So it's your typical mom and pop old school businesses. And this is very interesting because, for example, if you look at India, there are around 40% of the workforce in India is SMEs. It's crazy. You talk about more than 100 million people, and around, I think it's 40 something, 45 million companies which fall into this category. Our category is a bit narrower because we look at very specific, but I mean, the SME world is such a huge world. And then in terms of investments, nobody's investing there. I mean, you have private equity, which are focused on the very big companies, and you have the stock market, which is also very big companies, and you have VCs, which is startups and a different type. But this huge type of the economy, which is, I'm saying, I mean, in India, it's like half of the people who are work in this field, and no one is investing there, no one is growing it. So the beauty there is you're looking for hidden gems within SMEs, within these economy that's already existing, and the ones that you believe have a chance to grow, but will probably die because the founder is an old person who cannot work anymore. The kids don't think this is an exciting business, so they were going to leave. So instead of this business dying, even though it only has 20, 30 employees, you put in a fresh entrepreneur and you put in a new board member, people who are quite advanced, and then you take this business which was going to die and you grow it and eventually sell it to someone. So you get these hidden gems from within the bulk of the economies, and you work on them and grow them. So that's also an aspect which I think is very makes you feel you're doing something for the economy.
Absolutely, that's very interesting. And when you say mom and dad shops, so in that case, are these businesses always tech enabled, or can they also be brick and mortar businesses?
I mean, they can be tech enabled, but most of them are actually brick and mortar. Many of them are brick and mortar. The examples I gave you, for example, are all a waste management company. You have 16
Yeah,
employees. You collect waste from different places, and then you have some machines, of course, to help you. At the end
right.
of the day, it's not something that can be disrupted easily. It's a business that is yeah, no. So many of them are brick and mortar. Of course, some of them, for example, software is a very big chunk of the search fund worlds. And so, yeah, but usually you have the old school software still, like the generation who started in the 80s, 90s to do this type of software. You never find a R&D that wants something that needs a lot of capital, because search funds is not about growing through capital.
Absolutely. Thanks for sharing that. And now moving on to my last main question before we move into the rapid fire round. And this one is about once you've invested in the search funds, they have found their companies. Then from for the journey ahead, how are you supporting these companies become successful?
I mean, the way we operate is we consider ourselves part of this team. So we do anything necessary, let's say. In our case, during the search phase, we get experts, we call them our advisors, to any searcher that needs support. So, for example, let's say you have someone who is looking for a business in the automotive industry, and our searchers in many cases don't know the industries. Huh? They know they don't know the sector in depth, and then you get an advisor who knows the sector quite well, and then they can either give them an opinion on a company or on the sector, etc. So we do this, and then afterwards we become part of the board. In many cases, not always. If you can add value, we become part of the board. And then again, as part of the board, we do whatever is necessary. If it means we do a workshop for 2 days on sales initiatives, we do it. If it means we need to, we don't really we do anything necessary to grow these people through helping in strategy, sector knowledge. Organization is a big thing we do. So reorganizing the company, but again, you have an entrepreneur, and this entrepreneur is the leader of this whole cycle. We support, but we know our limits. We don't overly intervene. We let the entrepreneur do his or her thing, and we support as much as needed.
Absolutely. And I had just one more question pop up in my head. I'll ask that before we go for the close. And this is about, like, let's say you have backed an entrepreneur to go and search his company, okay, or her company. Uh, Maybe they end up finding the company, maybe not. But then at the end, you don't think that this is going to work out, right? At the second stage of investment, right? So how is that on? Let's say they took 2 years to find this company or not, then how are they sustaining themselves for this period of 2 years? Are you paying for them to do the search,
Exactly.
or how does that work? Yeah.
No, brilliant question. So basically, in the search, when they are raising the search fund, they collect around €500,000 from 15, 20 different investors. So each one of us pays maybe 30 to 40,000 euros. And after they collect this 500,000, they spend it over 2 years. Big chunk of it is their own salaries. Big chunk of it is salaries for their teams. So they are paid during this 2 years. And yeah, so that's how it goes. So they sustain themselves through that. Of course, they always have what you call a haircut. So usually they take, let's say, 70% of the salaries they used to take before, or so. It's never a very nice salary they get. However, it's enough to sustain them through these 2 years. And then once they become CEOs, then they take a CEO of this size of company salary. So they take market salary for this type of company, and then eventually, once they exit in 5 years, they, depending on the IRR they can take up to, depending if it's two together, they take up to 30% of the equity of this company. So they can make good money if they're successful in the end.
Great, that's very interesting. And at the second stage, are they also investing their own money in this company, or is it just the investors' money?
So in some cases, people choose to put some money, but usually it is the investor's money. In many cases, you have friends and family, maybe someone from the family that invests with them, but no, they're not required to put their own money at all.
Got it. But they'll still get that a decent chunk of equity to give them skin in the
100%.
game.
Yeah, yeah,
Yeah.
yeah, yeah. I mean, if they put their own money, then for their own money, they take extra. But they either take 25 or 30%. I mean, they don't take it all. If they, so basically depends on how much money they make. But if they get an IRR above 25%, then they take up to 25 or 30, depending. So if it's a solo, it takes 25% of the overall equity. So it's quite can make quite a lot of money at exit. So just quickly, I mean, if you look at the risk and return profile of search funds, many believe it's the most favorable because it is, you don't make as much return that you would if you do a unicorn. You would make much more money. However, the probability of success is also much higher. So if you look at it in the end, the return, same also for investors. Us investors, the risk is not that high, and the return is quite high in the end if you do well. So we don't have the huge peak that will make someone a billionaire, but also you will always make very good money, return on your money, and you'll grow sustainably. Just a final thought before we move to the last part.
Absolutely. That's a good remark to conclude. And now let's do the rapid fire round wherein I'll ask you the sectors and regions you invest in, typical stage of investment, etc. So if you're good for it, we can give it a go.
Let's go.
All right. So the first one goes, what are the sectors and regions you invest in?
So we are sector agnostic as long as it falls between the criteria of search funds. So if it's the size and the details, we do it. So sector agnostic. However, in the end, it's usually either services or B2B, simply because these criteria usually get us there. We invest mainly in Western Europe. So France and Spain are the biggest, but also not Greece, sorry, Portugal, Italy, Ireland now. So Western Europe is our main thing.
That's great. And what's the typical stage of investment? I believe just an entrepreneur has to come in and just back them, right?
So we basically we put in both in the search fund phase, and we also put in the actual investment phase. We put in both, and our average, I think it was your next question. If it is, I don't know. So we invest in the first one. Average is around 40,000 euros. In the next one, our average is around 750,000 euros. So that's how much money we put in each.
Great. So that covers my next question. Moving on to the next one after that, which is where can founders apply to get this funding from you?
Our website and our LinkedIn is a good way. So moonbasecapital.com, we have there a way to enter. And in general, I would say searchfunder.com is a good platform for everyone. But for Moonbase, our website is a very good way to connect to us. We're always happy to help and give advice. But searchfunder.com in general is a good way to know this world and learn about it.
Great. And last one, where can our listeners follow you?
LinkedIn is a great platform for us. I mean, please follow me on LinkedIn. I'm also happy to support and reply on questions, and so I'm very active. So please feel free to reach out.
Absolutely. I'll make sure to put all those links in the show notes below so that our listeners can get there easily. Thanks so much for coming on the podcast, Ibrahim, and enlightening us on this very interesting concept of search funds. Thank you.
Thank you, Prashant, very much. Thanks for having me. Have a nice
Pleasure.
day.